6% drop from here would be around 1484. What actually gets the market there?
Well, you know, Alex, that's a good question because it's hard to figure out what the trigger is right now. Clearly, you know, you guys mentioned the news and the economy really for anything in the month of March wasn't all that great, and so you would think that would be part of the trigger. But I think that we need to see some. It's not going to be earnings because I think earnings are going to be pretty much as expected. So it's going to probably be some sort of trigger that we're not counting on right now. And so whether it's something in Europe, whether it's something in the Middle East, whether it's something in China. But I think the volatility that we would expect, and some of the projective work we've been doing, you know, shows the bottom end of the range from now to the end of the year could be in that 1480 to 1500 level. But on the top side, you know, something on the top, we might see 1650, 1675. So I think volatility is going to increase, but it's hard right now to figure out what the trigger is going to be that's going to cause the market to pull back, you know, something north of 5%.
In other words, it's some sort of exogenous effect to the extent that there even is some sort of exogenous event that occurs. And I know that, Scott, you are longer-term bullish because you feel some of the indicators have turned, leading economic indicators. As you look at that kind of a chart, what's your read?
Well, I tell you, you know, the projective work that we've been doing on something like leading economic indicators, and we do a lot of projective work on those indicators. When we look out through the end of the year, and if you have that chart up, you know that the direction of that chart is up, and it's positive. And you know, sometimes you have to say, is the magnitude of that chart right? That one's not so steep, but I think leading indicators, based on our work, and this has been the case really for the last 2 years, it looks good through the end of the year, and of course leading indicators look ahead 3, 6, maybe 9 months. So really into 2014 and mid 2014, based on that work anyway, you know, we need to be positive, and we are.
Right, but then when you have a durable goods order that's coming out today, Scott, and really disappointing, you had RDQ Economics saying that it's really bringing into question the manufacturing growth here in the U.S., perhaps the U.S. being hampered by weakness in Europe. How does that factor in to this more bullish data that you're looking at?
Well, you know, I wanted to, Alex, you know, that the second chart that I sent was on the orders for durable goods, excluding aircraft, which that is very volatile, and certainly that affected the headline number this month. But if you exclude aircraft and it's non-defense, those were up a little bit. But of course, the revision, as a bunch of numbers were for durable goods today, were down. But you'll see in that chart that does not go up in a straight line. Once again, it's heading in the right direction when you look through the end of the year. But it's choppy. It's certainly a lot choppier than LEI, which tends to be more of a smoother type of a move. So even though we had that number today, and that's why I wanted to send this chart, the direction looking ahead is positive, but months like this are going to occur, and certainly that jives with much of the other data that we've seen in March. I mean, March stumbled, and you know, if you look out there right now, the Bloomberg consensus is 3.1% GDP in the first quarter, and when you see data like that and some of the data that we've seen recently, you know, I question whether we're going to get to 3.1%. We had come into the year looking for about 2% in the first quarter. I think it's going to be better than that, a little bit better. I don't think it's going to be 3.1% though.
All right, so all that said, Scott, bottom line, you got to do something with the money. What are you doing?
Well, I tell you, you mentioned the defensive sectors, and Adam, if you look historically and you see a market move like we've seen from the November lows, which is, you know, 18%, and we're up 10% year to date, that's rarely driven by these more defensive sectors. So I've been a little bit surprised by that. But I think from this point out through the end of the year, you're going to see much better cyclical performance. I think these emerging markets are going to come around late this year into 2014. The market's going to anticipate that a little early. Our economic growth, I think it'll be about 2.5% this year. Earnings growth of maybe 5%. So, you know, these cyclical sectors in the stock market can do well in a modest growth, modest inflation environment. So that's where we want to be. I just can't see these cyclical or these defensive sectors continuing to outperform.
Right.
Yes.
Very quickly, though, does that mean that you're fully invested, or are you still in cash?
No, we don't want our clients in cash. We want them to be fully invested here because really, Alex, it's a little bit of guesswork, but 12 to 24 months from now, that's going to be a good period for the stock market, I think.